Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Escalating threats. President Trump gives Iran a 48-hour deadline to reopen the Strait of Hormuz or face strikes on its power plants. Tehran threatens to completely close the waterway if attacked. Deepening global rout. Asian shares are set for a correction as they fall for a third day, and bonds sell off as the war raises the risk of higher inflation, slower growth, and interest rate hikes. And oil fluctuates near the highest close since mid-2022 as traders assess U.S. and Iranian threats. The IEA says the current disruptions are equivalent to 2 major oil crises. Well, it's just gone 9 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. It is day 24 of the Iran war. And once again, no signs of things letting up, with President Trump giving Iran that 48-hour ultimatum to reopen the Strait of Hormuz, or else they would target power plants. Iran defiant in response to that. So we're going to run through the latest from the weekend in just a moment. But of course, global markets are reacting to some of these developments over the course of the last 24 hours, 48 hours. Asia Pacific, the handover deeply negative today, down 3.3%. And this after a pullback for Wall Street yesterday and Friday as well. We saw a negative close for the S&P, for the NASDAQ. And again, there on really the investors and markets beginning to price in the possibility of a prolonged conflict, prolonged war, one that could go on for an additional couple of weeks, as opposed to a short resolve or a wind down, which is what President Trump initially hinted at on Friday evening. Now, Brent, obviously, all eyes still on the energy complex. We are trading at around $113, just shy of that, up about 0.5%. Just noting, and my colleague Dan Curtis flagged this to me earlier in the morning, that if you look out the contracts further out the curve, so the latter dates, what you're beginning to see is some of the later date contracts beginning to react as well, i.e. the curve is becoming slightly less backward dated, just another manifestation of how investors are beginning to price in a protracted war. Some of those longer dated contracts are beginning to get a bid as well. So keep an eye on that as well. Gold also interesting today to note that it's down another 2.5%. So it's loss after loss for gold, which is interesting in this environment. Up until the start of this war, it had been one of the major beneficiaries of uncertainty around. But actually, since inception, it has underperformed, which is interesting, especially as markets now are shifting towards pricing in interest rate hikes. And that has not been good for gold and for silver. And speaking of, take a look at where the 10-year yield is sitting right now. 4.40. We are up substantially over the course of the last couple of days. On Friday alone, we saw really, I would describe it as a meltdown for bond markets globally, from Europe to the US to the UK, moves of more than 10 to 15 basis points in some of these intermediate bonds, and also in the front end as well. Some of those 2-year yields really repricing to account for the possibility of rate hikes. The UK 2-year front end, for example, up 90 basis points over the course of this war. But switching over, because we've had so much volatility in bonds, take a look at the MOVE index. This is the underlying volatility index on interest rate swaps. And you'll see that for a while, it had not really reacted to the news that was coming out of the region. That all changed towards the end of the week, last week, and it has surged the most in over a year. So that is that MOVE index, and really just encapsulates how much volatility we're seeing in bonds and across markets globally on back of the Iran war. Okay, let's also check in on how markets in Asia are faring. Winnie Su is in our Hong Kong studio. Winnie, I sort of gave the headline here, which is that the handover has been quite negative. Give us some more details.
Yeah, morning, Jomana. Exactly. It is a risk-off day, and especially with that ultimatum being less than 24 hours at this point, we are expecting that to come tomorrow morning in Asia hours. So you can really see the sell-off across assets, specifically for equities. Like you just mentioned, MXAP down about 3%, headed into that correction territory. But yes, we are already down for the past 3 weeks, and now just about 1% away from erasing all gains so far far this year. Also in the technical correction territory is Japan's Topics Index here, down more than 3% as Japan did a catch down after coming off from a holiday on Friday. Now you have the dollar strengthening a bit, and hence that's also pressuring the FX market here in Asia. As you can see, Asia's currency index here down about 0.2%, and that is now around that lowest level since December. And across the board, lots of weakness, and specifically highlighting the Korean won here, which is now about the weakest against the dollar since 2009, despite that nomination of the new Bank of Korea governor, who is actually seen to be quite hawkish. Back to you, Jumana.
Winnie, thank you so much. Winnie Su in Hong Kong. Well, our top story today, the war in Iran is entering its fourth week and showing no signs of de-escalation. With the U.S. and Iran trading threats, President Trump has given Iran 48 hours to reopen the Strait of Hormuz or face the bombing of its power plants. Iran has countered the threat with one of its own.
If U.S. threats regarding Iran's power plants are carried out, the following punitive measures will be implemented immediately. The Strait of Hormuz will be completely closed and will remain closed until our damaged power plants are restored. All power plants, as well as the energy and information and communications technology infrastructure of the Zionist regime, will be extensively targeted. All similar companies in the region that have American shareholders will be completely destroyed.
For more, we're joined by Stuart Livingstone-Wallace, our executive editor for MENA and Russia. Stuart, a clear example of escalation dominance here. The U.S. are threatening Iran to fully reopen the Strait or else they'll attack power plants. Iran saying that if they do that, then other infrastructure sites in the region are going to be at risk once again.
Yeah, and I think not to be taken lightly, because you've seen exactly the same pattern over other incidents. So specifically when South Pars was hit, there was this retaliatory response against Ras Laffan and other energy infrastructure. But there was an additional thing here too, which is sort of, we're not quite sure how seriously to take it, but there was an additional threat of anyone that buys or holds US treasuries would also be a target within the region, which is sort of pretty much everyone. So going forward, we are only several hours now away from the deadline. We think it's probably around 4 a.m. our time tomorrow morning, and we'll see what happens after that. But there are something like 100 operational natural gas-fired power plants within Iran that the US could potentially target. And remember, this was a country that was suffering some pretty severe energy shortages as it is. So it's quite a serious threat from both sides.
And one of the reports that came out on Friday, and we've written about it, suggests that the U.S. is weighing up sending troops and Marines to the region to take over Karg Island. What do we know about the developments there?
So, I mean, it seems to be one of several options that they're weighing up, and really it all comes down to reopening Hormuz. So you did see some attacks, for instance, on Iranian installations around Hormuz at the end of last week. You've had calls for some sort of international armada, effectively, to try and reopen the strait, although the response on that from the international community has not been overwhelming. And this appears to be yet another plan. So potentially what you see, and again, I do say potential because nothing's been decided as far as we can tell, is to go in and seize Karg Island. Now, that's about 90% of Iranian oil exports, something like that. But that raises two very serious questions. One is that is boots on the ground, which is something that had not been previously contemplated. It puts US forces at much more severe risk. And thirdly, there are some questions about how effective it would be, because Karg Island is hugely important for Iranian oil exports, but they are not the only avenue that it has. So it has other terminals along the Gulf and in the Arabian Sea. Now, that would severely diminish the export potential, but it would still take something like maybe 1/3, 1/4 of where exports are now. And we know for a fact, because of many years of terrible sanctions against Iran, that it can survive on a trickle of revenue from oil sales. So how effective it will be is really an open question. Stuart
Livingstone-Wallace, our executive editor for MENA and Russia. Thank you so much. Well, for a deeper insight into how markets are faring, joining us is Stephen Major, Global Macro Advisor at Tradition Dubai. Steve, really good to have you with us. I'm going to start with the massive move that we had in bond markets, which is how I open up the show today. What do you think is going on here? Is this purely a positioning washout, or is it genuinely investors accounting for the real possibility that central banks may have to hike into this inflation shock?
Yes, good morning, Jemana. The fact that we're both working from home tells you part of what's going on here. The facts have changed, and positioning for sure is something here. But late last week, you know very well, it's been reported that there was an escalation in the region around several key tipping points, really. So there's the Strait and the question of its reopening, and then the attack on Qatar, which I think had a big impact on production capacity globally. So central banks, when they were meeting last week, they had some information, but there was new information coming through as they were meeting. So in terms of scenario analysis, if they were favoring a baseline or an adverse scenario, for example, they were probably tipping towards something even more severe. And I think markets got hold of this because a few weeks ago, we were talking about the specter of stagflation. That's now becoming a bit more of a base case. And so markets have to adjust. And of course, many people, it seemed, many investors were favoring the front ends at the start of last week. Those positions have been washed out. So the move has been exaggerated by positioning and the change in narrative from central banks.
Steve, at what point does the conflict shift, or people's perception of the conflict shift from, or the war shift from it causing a temporary spike to inflation to perhaps more knock-on effects more broadly, and one that actually would incentivize central banks to act? Is it, 3 weeks, 4 weeks, 6 weeks? Is there any specific time frame that actually triggers a change in thinking?
So as you know, all the discussions are around the extent of the damage and time periods, but everyone's just guessing. Markets are moving real time, and they're adjusting their probabilities and scenarios. And right now, the idea that this would be a short temporary conflict and the oil price move will be a spike, that looks to be in the rearview mirror. We're now preparing for the oil price being at a much higher level for a much longer time. The same with gas prices, and the idea that this would be a 2, 3, or 4 week conflict and then over doesn't seem to be a base case right now. So we are actually witnessing escalation. It's actually happening.
Yeah, and Steve, we talk about the potential for global demand destruction as well, and already you're seeing some elements of behavioral adjustment in some Asian economies, even European economies as well. In the case of Europe, what do you think is going to be more dominant, the hit to growth over the medium term or the inflation spike?
Well, you're quite right. The Asian economies are going to look at the oil price in a different way. In fact, I think that the price of a barrel of oil is clearing at a higher rate in some Asian countries than it is elsewhere. For Europe, for example, I think that from the ECB's perspective, inflation is clearly something they're looking at, and their severe scenario has inflation above 6%, and that means they have to act. And so I think that inflation is at the front of minds for central banks, especially those that felt that perhaps they were a bit behind the curve in 2022. So there's the kind of scarred central banker that doesn't want to make the same mistake as in 2022. So it looks to me like in the near term, it's the inflation that goes up faster than the growth goes down. But you do get a growth hit, and it starts to look a lot more like a stagflation scenario. I'm sorry to say that, because I talk about it hoping it's not going to happen. I wrote about it a couple of weeks ago, again, thinking of it as a scenario. But markets are moving real time to price these things in, and we cannot dismiss that stagflation scenario.
What happens to the yield curve in a stagflation scenario? Is it, again, one of the consensus trades at the beginning of this year was the steepener. In stagflation, will we continue to see this trend of flattening?
Yeah, the steepening trades have been largely washed out. There may be a bit more to go. I think that in a stagflation scenario, you get the bear flattening first, which is what we're seeing now, because the central banks are responding with narrative, if not actual rate hikes. They hiked in Australia and Iceland last week, but the other central banks are preparing to hike. It could be as soon as April, by the sounds of it, April, May, June. So that's a complete shift from where we were a few weeks ago. So in a stagflation scenario, the initial move is a bear flattening. But if stagflation takes hold, it's going to be the back end that really suffers, and you'll get a steepening of the curve. But we're in that first stage now, which is the bear flattening.
Stephen Major, Global Macro Advisor at Tradition Dubai. Thank you so much for that. Well, coming up, we discuss the fallout from the war in Iran with Rachel Ziemba, founder of Ziemba Insights next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, we are just getting some headlines come through from ADNOC Gas, and let me just bring them to you. They have said that debris has fallen near certain facilities, no impact, but that they have made temporary operational adjustments to the production of LNG and export traded liquids in response to the shipping disruption in the Strait of Hormuz. This is according to a filing on the stock exchange. They're actively collaborating with customers and partners on a transaction-by-transaction basis to fulfill commitments wherever possible. So temporary adjustments to LNG production, and that is from ADNOC Gas over here in the UAE. Now, in its fourth week, the effective closure of the Strait of Hormuz is heightening pressure on the U.S. and major energy importers. Iran has threatened to attack Middle Eastern infrastructure if President Trump acts on his vow to obliterate Tehran's power plants unless the waterway swiftly reopens. The closure is causing ripples beyond the region, evolving into a global fuel crunch.
I see that there is a growing problem in Asia, immediate problem in Asian countries, and this issue, especially in the context of products. Diesel and jet fuel, we will feel it more and more in Europe and beyond. It is coming through. Of course, again, countries have their stocks. We have our stocks, and we are incentivizing many countries who have refineries to move faster than they normally do.
That was Fatih Birol, the International Energy Agency's Executive Director, and joining us now is Rachel Ziemba, founder of Ziemba Insights. Later on in another part of that interview, Fatih Birol was talking about that this is the biggest energy shock that market has seen, even surpassing that of the 70s, because it's a twin. It's both gas and it's oil, as we just heard now, recent developments also from the UAE. Do you think oil markets, let's start there, are underpricing the extent of the supply shock?
I think the global oil benchmarks still are. Brent is up, is sort of close to 120, I think, as we speak. That's up a lot. WTI obviously lower due to supply dynamics in the United States. Sorry, I was overly optimistic. I think earlier in the trading session it was closer to 120. But we're really seeing prompt month, physical delivery, short term in Asia, we're looking at much higher premia. And so prices in the neighborhood 150, 160. So in terms of the actual delivered prices, as sort of refiners are scrambling, they're paying even more than this. So my assumption is if the Strait of Hormuz stays effectively closed, that we will see oil prices continuing to grind up. And that's even with the Strategic Petroleum Reserve releases and some of these new sort of sanctions exemptions, just because the scale of the effective outage shut-in production is so much.
Yeah. Rachel, are we likely to see more energy nationalism, and that you're going to see more and more countries put export controls on refined exports, on some of their actual crude exports. In the case of the U.S., I mean, they've ruled it out for the time being, but I do wonder whether this is going to cause another wave of energy protectionism around the world.
It's definitely a risk. We've seen a number of the Asian countries that are sort of refinery capacity put restrictions on temporarily. Places like South Korea, of course, China, quick off the bat. But I was also heartened to see Australia and Singapore coming up with an agreement earlier today in the Asian time to provide, to sort of allow some product markets dynamics. I think we could see countries swapping different supplies. Australia, of course, an important supplier of LNG, maybe swapping LNG in exchange for oil products. Where the U.S. is concerned, I would be watching especially oil products, diesel, gasoline, jet fuel and the like, rather than crude oil, of which it has plenty, and even natural gas, of which it has plenty. If anything, there's not enough liquefaction capacity in the U.S. to scale up LNG exports. And that's one of the things cushioning the U.S. Natural gas markets and power markets compared to the rest of the world.
Let me ask you as well, is it your expectation that Asia and other parts of the world will have to resort to less clean sources of energy? And we've heard about, many countries in Asia sort of moving down the clean spectrum, firing up any source of energy that's available, even if it's coal.
Yes, I think especially in the short term, we will see that shift. We had been seeing that trend, especially in some countries in Asia, emerging Asia in particular. That had been a trend already happening, moving to sort of coal on the one hand and renewables on the other hand, because they're cheap, but it's not easy to install renewables immediately. And I expect we might see some emission standards and the like relaxed. I wouldn't be surprised to see that in Europe as well. The focus is really going to be on what is available locally, what users can get their hands on. And I think we're also going to see some forced and implicit demand destruction as well. Some of the countries were quite quick off the mark to try to encourage people to turn ACs off and to, ration where they can. But this is going to be, this is going to be a larger shock. Over time, I do think we will see on the power side more renewables. And some emerging economies and frontier markets were already being priced out of LNG, and we're turning to solar. That medium-term trend is probably going to continue. But typically, when oil prices spike, when interest rates are high, that's not great for the installation of renewable energy either. And I am watching to see how the UAE, a major foreign sort of supplier or investor in renewable energy, as well as other energy around the world, sort of how some of those projects continue. In the short term, we might see some stalling, some holding off on new projects.
Rachel, thank you so much. Rachel Ziemba, founder of Ziemba Insights. Now for a look at some of the other stories we're following today. UBS Group Chief Executive Officer Sergio Motti says energy prices are likely to remain elevated as investors digest the impact of the Middle East conflict on the global economy.
These are likely to stay high for the foreseeable future, putting some inflation pressure and also some pressure on the delivery chain or on the supply chain. And in that sense, the situation is a little bit unstable.
A federal jury has found that Elon Musk defrauded Twitter investors when he disparaged the company in 2022 in an effort to buy the social media platform for a lower price than his original $44 billion bid. While the jury rejected some of the fraud claims, Musk now faces potential damages totaling billions of dollars to be paid out to affected shareholders. Musk's legal team plans to appeal the decision. And coming up, Goldman Sachs warns the Iran war could deal significant blows to Gulf economies. We'll speak with Farouk Soussa, MENA senior economist at Goldman Sachs, next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Escalating threats. President Trump gives Iran a 48-hour deadline to reopen the Strait of Hormuz or face strikes on its power plants. Tehran threatens to completely close the waterway if attacked and strike back at key energy and water infrastructure. Deepening global rout. Asian shares are set for a correction as they fall for a third day, and bonds sell off as the war raises the risk of higher inflation, slower growth, and interest rate hikes. And oil fluctuates near the highest close since mid-2022 as traders assess U.S. and Iranian threats. The IEA says the current disruptions are equivalent to 2 major oil crises. It's just gone 9:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, the Iran war, day 24, creating global turmoil in these markets. The handover from Asia Pacific decisively risk off today. Deep declines there, down 3.5%, very close to correction mode. So a pullback of 10% for the broader Asian index. And also, I should say that the Wall Street close was also negative as well, as investors really come to terms with the possibility of not just the war and the immediate impact to energy supplies, but also the real possibility of a protracted war that could go on 4 weeks. And here we're not just talking about flow disruption, but actually potentially some energy destruction as well, with some of the damage that has been leveled on these key energy infrastructure sites. So that is the theme going into this week. Brent is trading just shy of $113 here. We're up about 0.4% at levels not seen since 2022, but of course still a lot of risk premium baked in and uncertainty about the outlook ahead, especially with the Strait continuing to be effectively shut or under Iranian control. Gold also slipping once again, down 3.7%, continues to drop actually, which is interesting, pulling back as investors start to account for a rate hiking cycle out of central banks. And that is obviously manifesting with where 10-year yields are trading and more broadly across global fixed income markets. Right now, 10-year yields at 4.41. We moved up about 11 basis points on Friday. Similar moves for other global fixed income markets as well, as there, once again, investors price in for stickier inflation to come and the reaction function, possibly more hawkish reaction function coming out of central banks. So let's switch over just to encapsulate how much volatility we have seen in these global fixed income markets. This is the MOVE index, and it essentially tracks options volatility on interest rate swaps in the U.S., so specifically to the U.S. And you'll see that for a while it was sort of not doing that much, but all of that changed in the last week, and we started to see a real unbuckling of some of these fixed income positions in 2-year and 10-year. We talked about the steepening at the beginning of the show as being one of the consensus trades going into 2026. Now the curve has been so-called bear flattening. The front end has been moving up substantially alongside the 10-year as well. So a lot of volatility being priced into bond markets and also into global markets as well. And with that, let's talk about some of those global markets. Winnie So is in Hong Kong for us. Winnie, break down the price action in Asia today, please.
Yeah, morning, Jumana. As you mentioned, we are hearing from investors in Asia that they are trimming equity exposures and also trying to secure liquidity ahead of this deadline from President Trump within the next 24 hours or so. So hence you are seeing MXAP, you just mentioned, heading into that correction territory along with Japan's Topics Index, which is down about 3.5%. We had the holiday on Friday, so a bit of a catch down there. But also when we are looking at MXAP just about 1% away from erasing all of its gains so far this year. You just mentioned gold as well. That is also around that level. Now you flip the board and take a look at the fixed income space. You just mentioned that global bond sell-off. For example, here we are also looking at Japan 10-year yield up about 3 basis points, taking us to the highest level around the 1990s. So that is also pressuring the Japanese yen, which is still hovering around that 159.5 level against the dollar. And when it comes to the Korean won, also seeing quite some bit of weakness, even after we just nominated the new Bank of Korea governor, who is seen to be actually on the hawkish end. The yuan here also slipping just a bit with that weak fixing coming through from the PBOC. Back to you, Jumana.
Winnie, thank you so much. Winnie Su in Hong Kong. Well, oil prices are near mid-2022 highs as investors weigh Trump's ultimatum to Iran. With the conflict showing no signs of easing, the International Energy Agency's executive director, Fatih Birol, says the energy shortfall dwarfs the oil shock of the 1970s.
Only as of today, we lost 11 million barrels per day. So more than 2 major oil shocks put together. Plus, after Russia's invasion of Ukraine, the gas markets, especially in Europe, we lost about 75 billion cubic meters, 75 BCM. And as of now, as a result of this crisis, we lost about 140 BCM, almost twice.
Good context there from Fatih Birol, the IEA chief. For more, I'm joined by our energy reporter, Anthony De Paula. So we heard from the IEA chief just sort of describing how big a moment this is for energy markets. But Anthony, coming up, we're heading into what could be a crucial 24 hours with, President Trump threatening to strike power plants in Iran, Iran threatening to retaliate as well. I mean, how are oil traders, how are energy investors viewing what could happen in the next couple of days as it pertains to energy infrastructure?
Good morning, Jumana. Yeah, those threats, one against the other, of those tit-for-tat attacks, that's kind of the worst-case scenario that energy markets could see in a time when none of the scenarios are looking really good for the energy market. As we heard from the IEA director, he's talking about this worst crisis in a long time, which is the situation that we're in now with Hormuz blocked and with the supply taken off the market. It could get even worse if those tit-for-tat attacks do happen. Of course, around the 112 area, we're near some of the recent highs, but we're clearly not at levels that would indicate that much of the energy infrastructure in the Middle East has been destroyed. So to your question as to how markets are looking at that, yes, there is some concern. There is that big risk looming. We still have prices elevated, but perhaps the price reaction is being tempered a little bit by other comments by Trump, like he's looking to try to wind down the crisis, by some comments from other energy-consuming countries that they would condemn the closure of Hormuz and potentially could work together to reopen that. So we've got these kind of massive threats going that really could ruin the future prospects for the energy industry in the Gulf, with this kind of moderating language of the winding down and trying to work towards opening that. So traders have a high level of risk, but we're waiting really to see if there is that actual attack.
Yeah, still lots of mixed messaging coming through from the White House. Anthony, one other big announcement that I think caught many by surprise was the U.S. Treasury announcing that they were unsanctioning Iranian oil that was already on waters. So talk us through the impact of that, and also exactly how many barrels is it going to be impacting?
Yeah, so similar move there compared to what they did with Russia in allowing the sale of oil that's already on tankers. Normally, when you put oil on a tanker, it's already been sold to a refinery. But in the case of Russia and even more so Iran, they are putting oil on tankers, shipping it out, hoping that they'll find a buyer. or are able to disguise the origin of that crude when it comes to the Iranian crude and get it to a buyer at some point. The estimates are wildly different, over 100 million barrels a day, up to 150, 170 million barrels a day. Of course, the Iranians are saying they don't have anything on the water to sell. They're saying it's already been sold. And then the U.S. Treasury was also talking about that money not going back to Iran. So that also raises the question of how people are going to engage with that, how people are going to pay with that. And there's also some doubt about refiners who have very fixed kind of runs for the crude that they take. Would they be able to take that Iranian crude indirectly? So there's still some questions about that. Obviously, it's trying to put a cap on the price and talk the price down a little bit. It won't be fully effective in doing that because we still have a lot of supply off the market, Jumana.
Anthony, thank you so much. Anthony DePaula, our energy reporter over here in the region. Now, the Iran war is raising the risk of a sharp slowdown across Gulf economies, especially if disruption to the Strait of Hormuz continues. Goldman Sachs says Qatar and Kuwait could see deep contractions in a prolonged conflict, with Saudi Arabia and the UAE also facing slower growth. Joining us now is Farouk Soussa, MENA senior economist at Goldman Sachs. Farouk, really good to have you with us. You wrote a report in which you laid out a scenario where this goes on until the end of April, which you have called the prolonged war scenario. Increasingly, this is beginning to look like the baseline, if you go on what the latest reporting suggests. But in that scenario, you mentioned that Qatari and Kuwaiti total GDP could decline by as much as 14%. And in the case of Saudi Arabia, 3%. In the case of UAE, around 5%. These are big numbers. Do you stand by them?
Yeah, I mean, good morning, Giovanna. So there's no doubt this is going to be a big economic hit for some countries in the region, as big as COVID. The numbers that we put in were a prolonged war scenario, intended to be sort of like a downside scenario. Increasingly, with the escalation we've seen and with duration risk sort of pushing out, they seem to be relatively, we're coming up to those numbers, I think. Now, but there's something very important to remember here. Those large numbers that you described, they are the combination of both the impact on oil production and the non-oil economy. So while the overall GDP hit is going to be very large, unlike during COVID, it's not really going to be all in the non-oil sector. It's going to be a combination of the oil sector and the non-oil sector. And that's just mathematics, right? We're seeing virtually zero production in places like Kuwait and Qatar and Bahrain. Of course, the longer that drags on, as a percentage of annual production, you're going to see that coming down very significantly.
Yeah, and Farouk, on the oil point, how much has the UAE and Saudi Arabia's ability to reroute some of the oil actually cushioned the economic effects or likely economic effects?
Well, there's two things. So it cushions the effect on oil production, the fact that you have the East-West pipeline and the capacity perhaps to divert about 1.5 million barrels that way in Saudi Arabia. Plus you have the ongoing exports via Fujairah in Abu Dhabi. So that helps cushion the economic impact, but more importantly, it helps cushion the financial impact in those countries. If you consider that oil production and oil exports might be down around 2/3 in both of those countries, but the fact that oil prices are up so significantly, you can see that there's an offsetting impact there. So I think it's crucial that these countries continue to have those lifelines. Oman, which is outside of the Strait of Hormuz, is going to be considerably better off from a fiscal perspective, an external perspective. Of course, the economies in the region as a whole are going to feel the drag from this.
Yeah, and from a non-oil perspective, which countries in the GCC would you say are the most exposed to a prolonged war?
Well, I think to varying degrees, all of them are going to be exposed. I think those countries that are seeing the biggest disruption to supply chains, the ones that are within the Strait of Hormuz, are going to see a relatively larger disruption to supply chains and therefore hit to their non-oil economies. Those countries that are more exposed to tourism, that have bigger aviation, logistics, and similar industries that are dependent on the movement and flow of capital, goods, and people, those are the kind of countries that are going to be feeling the impact of this more keenly. But Jemana, I would like to interject with a kind of a more positive kind of narrative in this. While undoubtedly the hit is going to be very large for these economies, and undoubtedly could be a very painful financial hit as well, we have to remember that these economies, from an economic perspective, are relatively resilient economies. These are economies that are dominated by state-owned enterprises with very deep pockets and very patient capital, and that is going to help continue to push investment through these economies going forward and help resilience and recovery. And from a financial perspective, yes, of course, there are going to be financial losses, particularly in those countries that I mentioned that are within the Strait of Hormuz and who cannot get their oil out. But we have to remember two things. Number one, oil prices are likely to stay higher for longer, even as production comes back, as we embed a higher security risk premium and geopolitical risk premium in oil markets. And that's going to help compensate for some of those production losses in the near term. And then, of course, number two, these countries happen to be the most capital-rich countries in the world, on the planet. They have something like 200% of GDP in external assets that can help absorb some of these losses. So while we stand definitely by the impact that the war is having on these economies, and it is a very large impact and may mean very large financial losses, luckily, these countries are very resilient, and these economies are extremely resilient from both an economic and a financial perspective.
Yeah, really important to point that out when you think about what happens after the war and these these countries' abilities to sort of grow back. Let me just ask you one thing. Should we start accounting for the possibility of a big splurge to come in GCC's defense spending in the coming years?
Well, that's certainly a risk, but I think it's a bit premature now to think about the post-conflict order. I mean, clearly things are going to change in terms of geopolitical relationships, both within the region and the region's relationships with outside powers. So we don't really know how that's going to evolve, but certainly in our forecasts, yes, we are accounting for a moderate increase in defense spending, and also, of course, an increase in general spending in order to rebuild the destruction that's happened to existing infrastructure as well.
Farouk, Soussa, thank you so much for joining us. I know it's early in the UK. We appreciate it. MENA, senior economist at Goldman Sachs. Well, coming up, the Trump administration reorganizes U.S. foreign aid to a fraction of its previous size. We'll bring you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Bersachi in Dubai. The Trump administration is overhauling U.S. foreign aid, restructuring it at a fraction of its former size after dismantling USAID. Critics warn the move has cost millions of lives, with one study suggesting it may result in about 14 million additional deaths by 2030. Our chief Africa correspondent, Jennifer Zabazaja, joins us from Johannesburg. So what does this new foreign aid structure look like, and how much smaller is it, Jen?
Right, Jemana, really what we're seeing from the Trump administration is an overhauling, a reorganization of foreign aid, as you were just mentioning there. And what's key is that we're now seeing a disaster and humanitarian response bureau that's fully consolidated under the State Department. This is different than what we did see from USAID, which was its own agency within the government, had a bit of oversight from the State Department. Now we're seeing this bureau fully overseen by the State Department. As you were just mentioning there in the intro, we're also seeing the staffing more than a third than it was prior to this with USAID. Employee count is just over 200 people, as some of Bloomberg reporting is suggesting, which is about a third who worked with USAID. And we should mention that this is essentially reflective of what we have seen from the administration's overhauling of foreign aid globally. A lot of this has been affecting sub-Saharan Africa, which had received quite a bit of aid from USAID prior to its dismantling dismantling last year. And just to give you a sense of how seismic this has been, right now we're seeing the budget at about $5.4 billion for the humanitarian budget compared to back in 2023 when it was $43 billion under USAID. And as you were just mentioning there in the intro, the concern really are the cascading effects that this could have for a number of countries that were receiving some of these benefits.
Yeah, I mean, what is the projected impact of overhauling all of this U.S. foreign aid, Jen?
If you talk to the administration, they say that they are making this more effective and focusing in on life-saving programs. But if you talk to a number of others who are looking at this from the outside in, the concern is that the U.S. is going to be less and less effective and relevant in terms of its global impact, especially when it comes to health. Now, the concern really here is potentially how this affects more broadly down the road, especially when it comes to health. We've done some Bloomberg reporting that suggests, as you were just mentioning in the intro there, the potential for this to affect life-saving efforts that USAID was trying to do in the past. What's also happened, though, at the same time as we've seen not just the U.S., more broadly, Western governments have scaled back some of their own foreign donations and contributions to a number of countries, many within sub-Saharan Africa, as we should mention. That has also had an impact on a number of philanthropies and also private donors who have now had to try to step in and fill the gaps. But of course, as you can imagine, can only do so much. And really, the concern when we speak to a number of officials, many of whom were watching when USAID was working in the past and are now watching how this affects it going forward, is how is this going to look for many of these life-saving efforts that had been a focus for the U.S. administration in the past? What is that going to look like for future generations and the workforce more broadly?
Jen, thank you so much. Jennifer Zabazaj, our chief Africa correspondent in Johannesburg. Now, sell-off in stocks, gold and bonds deepens as investors pair risk on inflation fears as the U.S. and Iran signaled a potential escalation of the war once more. For more, Bloomberg's executive editor for Markets Live joins us from Singapore. Mark, one of the charts that I was looking at this morning, amongst many, was the pullback in Asia-Pacific, MSCI Asia-Pacific. I believe more than correction now from the highs that we were at a couple of weeks ago, a pullback of more than 11-12%. Is it fair to say that complacency in this market is over now?
No, I'm afraid not. Look, complacent positioning is normally only a short-term driver. It's normally quite dangerous to hold a bearish view on the idea that investors are complacent beyond the short term. And normally what that subjective term of complacency is just different investment horizons or different risk tolerance. So normally what happens is we have some negative risk-off event. Those who need to sell because of margin, because of mark-to-market, whatever reason, they sell. Those who panic sell. And then the rest of the market stays long because they don't care. They don't care about the volatility. They don't care about the timeline. I think that's kind of different here. I think there's an underlying complacency that's much stronger, and that's because people are probably depending too much on AI for their analysis, and the AI platforms are defaulting to the precedents in this situation. And the precedents go, Trump always tacos, Middle East conflict always blows over, it's always a fade, the midterms are coming up, Trump's got an incentive to wind down. They're all kind of based on the idea of precedent where the US has unilateral or near unilateral control over the fate of the conflict. And that's just not the case here. And so the AI models that are helping all the analysis for everyone aren't useful because, in fact, the key protagonist in this is Iran's decisions around the Strait of Hormuz.
Yeah, it takes two to tackle in this circumstance. I want to ask you about gold. I just got a flash come through saying gold has dropped 4.1%. It's completely wiped out the year-to-date gains. And actually, we've dropped more than $1,000 from the highs that we reached at the end of January. So gold is technically in bear correction mode now. So what is going on there, Mark? And why is it not acting like a safe haven?
Yeah, look, I think it should have more downside from here. We've written about this a lot for the last couple of weeks, I think, since the Monday or Tuesday after the conflict started. This is a scenario that should be very negative for gold. The three marginal catalysts for gold are the fact that we've got a much stronger dollar. Obviously, this is the one crisis of which dollar is the ultimate haven. You can't go to treasuries in an inflation shock. So you're going to get dollar is going to do much better. You're going to get higher yields because of the inflation shocks. They're both the big marginal drivers of gold. And finally, if you bought gold because of geopolitical risk premium, like in case there's conflict in the Middle East, well, you've got a war involving about a dozen nations in the Middle East and US fully involved. It's about as bad as it can get. You can't get more escalation here without some really doom-mongery scenarios. So therefore, if you bought gold for the geopolitical risk scenario, you should have taken profit on the Monday after the invasion, patted yourself in the back and looked for another trade. So yeah, gold I think still has more downside from here. I'm not saying the short term has already gone a long way, but I think over the coming weeks, months, yeah, I still expect it maybe 3,600 level where the breakout was last year.
Okay, 3,600 will get you back on. Mark Cudmore, Bloomberg's executive editor for Markets Live. A quick look at how equity futures are shaping up as we head into the European session. It is not pretty out there. Lots of red on the screen as the market really accounts for further potential escalation in the Iran war. European markets down 1.4%. But that is it for our show, Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.